How's your week been?
Week's been good. I've been very busy with work, unfortunately, but very interesting project, so I can't really complain. How about you? How's your week been?
Very good. I'm two of the startups, two of which of the few that I feel like, as everyone, or as you know, I'm a big fan of Cal Newport and his work on deep work, finding flow, and I feel like when you take on too many, and now I'm learning what the man Buffett says about learning to say no to opportunities, is because it stretches you and you kind of lose focus. So got to the point where I'm like, fine, not taking on any more work. So it's like I'm working with a few startups on an advisory basis, and it's like I'm not doing any more. And despite really interesting ones that come in where
you've got to learn to say no.
As Naval says, long-term games with long-term people. You're like, I really want to work with this team. But you just have to learn to say no.
Can't you just get rid of shit sometimes and say, I don't want to do what I'm currently doing because this new opportunity is so good?
No, because I want to be doing everything that I'm doing. That's the problem. This isn't corporate wear. So last week was an introductory episode, last episode. This one is basically, next few episodes, look, we're just going to riff on a bunch of different VC topics and tech investing, market, angel, anything to do with building or investing in tech. I suppose today, first good point to start is, as most people should know, but for some of the listeners who don't know, let's dive into a very quick introduction, 1 minute, of what the hell even is VC, what is venture capital, and before we go on to the landscape and our thoughts on the current state of the space and why things are changing.
All right.
Cool. So what's VC?
Fucking throwing me under the bus. So VC, from my understanding, is basically investing in, I guess, very early stage companies and investing in them an amount that can help them grow and help them get to that point at which they can IPO. There's also probably, there are different stages that you can invest as a VC, pre-seed, seed, whatever, Series A, Series B. And I think, I don't want to go into all of that detail. You can Google it and figure it out, like, you know what it is once you read it. But I think most VCs, their number one aim is to make a return for themselves, for the general partners and the limited partners, and and do so by investing in new companies that are doing cool things.
The problem which a lot of people have, and we have had for a while, is VCs admit to this. Some of our friends or people that we know who are VCs say, yeah, we totally agree that it's like a dartboard. You throw 20 at the dartboard, 2 of them stick, the other 18 fall. The 2 that stick, the returns are so exponential that make up for the losses you make on the other ones. And they're fine with it and they're aware of it. But there was this discussion me and you had a while ago. I actually wrote an article a few months ago that I didn't publish.
Yeah, after I told him not to.
Basically, I got you to proofread it. I got you to, because I usually like to send it to 1 or 2 people, and of course, I sent it to you straight away. I feel like I'd burn a lot of bridges if I published the article, because I'm not yet, let's say, in the position of someone like Naval or Chamath or any of the big hitters in tech who's in a position to say that. Basically, I'll riff on a couple of the points just to get my point across, because I think these are valid points. Let's look at Casper.com, which is they're basically flipping mattresses online, e-commerce. Wow, much innovation. They filed for an IPO and went public a few months ago. Unlike a decade ago, it's now becoming a trend to go public, even if you're doing 300 million annual revenue while losing $65 million per year bottom line. Mind you, this isn't even true bottom line. Wink, wink, when you start adjusting. A mattress company, not tech, they make a loss on every sale they make. Quote unquote growth strategy. So like that's the beef I have, and I probably jumped in way too quick into the beef I have. But there's a lot that I love about this space, which is why we're doing this. Like, I live and breathe it. But at the same time, these points are valid. Like,
well, look, if you think about it, you mentioned this in our first episode. There are economic incentives, right? So everyone has an incentive to act in a certain way, and in these scenarios, you've got the structure of a venture fund, right? How is that structured? Well, you've got the GPLP structure. Your general partners, they basically manage. They're your managing partners. They make the investment decisions. They run the fund. Then you've got your LPs, which are the people that invest the money that you can then go and deploy. Institutional investors, pension funds, family offices, I don't know, endowments, anything, right? High net worth individuals are chucking their money because they believe in the GPs to do the right job. Now, where do the economic incentives lie there? Well, mostly with the GPs, the LPs just expect a return. As you said, the returns can be high. So you give leverage to those GPs. Those GPs are making decisions based on what they think the future of a company can look like. Much like how when you trade stocks, right? I guess you're trading because you're trading on the future value of that company, right? Hence Tesla. Like, what the hell? Why is Tesla like so why is Tesla's valuation so high? Well, it's because people think that the future is going to be run by Tesla. Energy, cars, whatever it may be.
Yeah, you're betting on the growth.
You're betting on the growth. So this is the point that I think gets to the Casper thing. Venture somewhere, one GP or a couple of them have thought, fuck it, these guys are going to make a shit ton of money, and this is just the way they do it. Yeah, okay, today they're making a massive loss. But because we're not privy to that information, because we can't see behind the curtain of what these VCs are thinking and why they're investing, although some VCs now do publish, post hoc after the fact their reasoning, these guys don't really show much, right? And so we're left in a world of you sitting down, getting really angry and writing op-eds.
I wouldn't say angry, but yeah. But
well, the way you wrote that is, I'd beg to differ. No, but
I'm calling people out on their bullshit, which is again the purpose of why we called the podcast what we called it. But
yeah, I agree with you. And look,
we're truth seekers. I did a personality test and it said I'm a logician, and the second time I did it said I'm a debater. And the third and fourth time I did it, I got the same two results again. So combining those, I suppose, leads to why I'm always curious, and so are you. We're very similar, and we're always challenging people. And look, we don't have beef against anything. We're just trying to get to we're trying to make it as scientific of an approach as we can. Yes, it's not completely scientific investing in tech companies, as some of the most notorious VCs with decades of experience would admit. It's not. There's not much science to it, some would say. But to the extent there is, we're trying to figure it out.
Well, I think part of your question is answered by the fact that you I think, was it you that introduced me? Someone introduced me to the product market founder fit, right? Mm-hmm. So a lot of the times, Jason Calacanis says this really well. He says, I bet on the people. So if the person fails the first time, he will bet on them again in their second venture. And he says 3 out of 4 times they're going to fail. So the fourth time, I'll get them.
10-year batting average. Like, I see it around with founders all the time. It's what it takes. Like, a lot of them fail first 2-3 ventures, but eventually they hit.
And that's what you're betting on. You're betting on the person. So venture might actually be getting the person, finding that person, and then once you find the person, betting on them over and over again. But it goes back to that dartboard point. What the hell are you doing as a business, taking institutional or pension money and throwing it at a dartboard? Well, your argument could be, okay, you're making a 30% return per annum, and so it doesn't matter if you miss 29 of the 30 dartboards, one of them hit, one of those darts hit, and you're winning, you're getting that 30% return. So it's each to their own, I assume, but because we don't have a view of what the hell's going on, it causes stress and it causes the tech bro debate on Tesla more so than anything. I've seen this like so much around people just being like, Tesla's this, Tesla's the future, Elon Musk the greatest, he's trolling everyone. He goes out and he tweets something or smokes weed on Joe Rogan's podcast and the stock rises. A lot of that is driving a sense of polarization and tribalism that is, I think, in the longer term, probably problematic for this market. Because you just, instead of bringing everyone together to find solutions to the biggest problems that we have, for example, Chamath posting on Twitter that, if you want to help me solve the climate crisis, send me I think it was a 7-pager thing that we could take to market. Instead of it being that, it's becoming, you're wrong, you shouldn't be investing in Tesla, you should be investing in Nvidia, you should be doing da-da-da-da-da. And you get into this argument.
And that's why we're here. That's, again, we go back to the purpose or the mission or why we launched this. That's literally why. It's funny you said Jason Calacanis is betting on the people and not so much the product or the idea the first time around. And I suppose a big part of that is the talent and the ability, the mental models. Again, for those who see Munger on the wall here and know I'm the biggest fanboy in the world for many years now. But the mental models that you use to not only judge people, to be basically to be in a good position to identify, is this guy going to be the type of person I can bet on? Do I want to bet on this guy for the next 10, 15 years? Your ability to understand human behavior, Robert Greene, laws of human nature, all of these things, to read body language, read tonality, cues of are they bullshitting me? Because those things are not always really a science. It's more your people skills, really, but at a very, very high level. So yes, I agree with that. I had another, and also a friend called me recently, and he works in IUB, and he said, "Oh my God, I've seen this chart recently. It showed how VC outperforms all other asset classes by crazy amounts." And I said, "Yes, I've seen that chart too. Did you look at the losses as well at the same time?
Yeah.
Did you look at because it also is the most loss-making asset class at the same time." So I totally agree. So look,
was he looking to get into venture, this guy?
He was, as is everyone else.
Yeah, he was thinking of things to write on his cover letters, probably.
Hey, I told him become a good operator before you become a VC, but that's my 2 cents, as you already know. So what else did you want to talk about in terms of? So you were talking about you gave a very brief introduction. Look, most people know what VC is. You can do better reading than our 1 minute explanation can give, because we like to riff on topics that could probably provide better context and real world examples. So the landscape basics, who are the big players? I mean, your tier 1 VCs, you've got your Sequoias, Benchmarks, Accels, Andreessen Horowitz, a few others, apology if I've missed you out. And then you have your tier 2s. Now, what I realized is some people that I've been speaking to recently, a lot more experience than I have in VCs, they say to me, the only place you see really high returns for a short to medium term are new managers. This is basically the principals and the partners from the brand name shops, some of which I just named, go to set up their own fund for the very first time. They still have the brand cash of their previous employer.
Yeah.
They still have all the contacts, and their deal pipeline is essentially a shadow of the deals they saw at, let's say a Sequoia. So even if Sequoia passes on a deal, that doesn't mean it's a bad deal.
Yeah.
They miss things as well sometimes. Now, just to wrap up, because I know you've got interesting thoughts on this, those funds tend to do quite well on their first funds, because you're bringing all of your pipeline and contacts and everything from Sequoia to your own brand new fund. They tend to do less well on their second funds and less well still on their third funds. Why? They raise more money on each subsequent fund without improving the quality of their deal flow. And to be honest, arguably the best deal flow exists in the very first fund, since those deals have traces of what they would have seen before they set up their fund from a tier 1 VC. Now, perversely, most institutional LPs don't have meaningful emerging manager programs and are reluctant to back a first fund, so they miss out on a lot of this deal flow. Those same LPs then make the mistake of investing in Fund 2 or Fund 3 before the returns from Fund 1 are realized. Each subsequent fund tends to be easier to raise capital for, and as a result, assets under management increases. This generally results in lower distributions to paid-in capital for follow-on funds than for first funds, but most investment consultants, endowments, foundations, pension funds and family offices say don't invest in first-time funds, mostly because those funds don't pass operational due diligence at the investment consultants like Cambridge Associates, Alborn or Mercer or whatever. So just to wrap up on that point, the situation is compounded by the fact that 10 years ago, the average time between fundraisers was more like 3.5 years. Someone corrects me if I'm wrong. Now it's more like 2.25 to 2.5 years. That means you have GPs basically always raising capital instead of focusing on deals and LPs committing capital before DPI is known on the last fund. And frankly, some of the VCs in the space tell me that they think that's pretty much dumb. That's stupid currently.
It is for some VCs, I agree. It depends on the VC, right? So a lot of VCs the GP focus will be on the growth element, right? How do I get my money to work better for my investors and myself? Not through investing, but in growing my own business, right? VCs are businesses as well at the end of the day. What's interesting is a lot of what you've said builds on, I guess, There's a video I think on YouTube of Chamath Palihapitiya talking about this, and he talks about venture as essentially being, maybe he was talking about funds in general, but venture being, I guess, a Ponzi scheme, being a pyramid scheme. And this is part of it. It's kind of, I make money on this, on my first 10 dartboards that I throw at the board, therefore I'm good, therefore I raise money, and therefore my mate who's been raising money with me goes and sets up his own fund, he does the same thing, da 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 da. But the interesting thing is the funds that focus on growth, as the statistics you point out show, have such a large group of people that sit within that fund to manage their investments, to manage their founders, to manage growth of the companies that they're investing in and find other companies to invest in, that the GPs feel a level of security and their focus then moves on to grow in their businesses. So I think there'll definitely be VCs out there that will agree with you. I think there'll definitely be VCs that would counter that. But at the end of the day, they're making money. You're literally back to the first point you made. And the fact that they're making money, is that a reflection of tech doing well? And I want to get onto the founder point here around how basically founders are propping up VCs in a sense. But is it the thing that they're investing in, the area that they're investing in, that's driving them to do well? Much like any Tom, Dick or Harry who's put money in Amazon, Google, Facebook, Apple over the last 10 years will have made money. Or is it something that they're doing specifically as part of their deal flow and finding the right investments to make that's enabling them to win? Because realistically, there's going to be I throw a number out there, 10,000 startups that start a day around the world, tech startups. So they have an abundance of options. How do they pick the right ones? On the founder point, sorry, I rambled, but the founder point is quite important. You and I had a late night discussion once, if I remember correctly, around the founders of the future, and that sounds ridiculous, but the founders that are going to exist in the future are going to be Elon Musk's. They're going to be people who can build, they're going to be people who can sell, and they're going to be people who understand how to negotiate the problems that exist with people in the investment market.
So basically anyone who listens to Naval's advice and puts it into practice, learn to build, learn to sell. Learn to build and learn to sell, but those guys that win 3 out of 4 times, or 1 out of 4 times, whatever the ratio is, they, in my eyes, are going to be people that are building as well in the next 10 to 15 years. So if you're a VC listening to this, or if you're an angel listening to this, obviously you're going to look for people that are both a technical and non-technical founder in one. People like, accelerators like YC kind of steer clear of this. They're like, well, find yourself a non-technical and a technical director. But why? Like, I understand there's the amount of work that's going to be on your shoulders, but if you live and breathe your business like Musk did with SpaceX and Tesla, which, correct me if I'm wrong, was like his third and fourth, or second and third businesses, you should be able to win in the market, and you should be able to give investors confidence that you know what you're doing, but equally win in that market. But anyway, that's my ramble. What are your general thoughts on where VC's going?
So before I get onto that, just to add to on what we just discussed now, I agree mostly, and not, to be honest, institutional LPs aren't the cleverest in the world. They're basically they're asset allocators, and when it comes to PE, VC, and these, especially VC, they're essentially gambling. But if they're allocating, let's say 5%, then it's like fine. And that's where, when my friend called me, he's like, "Whoa, have you seen the returns in VC?" And I'm like, "Yeah, but have you seen the losses in VC?" That's where I suppose they can gamble. It's like when it goes back to the Bitcoin argument or crypto, where, yes, because I dabbled in it for a while a few years ago, to this day, people still, it's funny as well, because they, I can't remember it word for word, but Munger says you should be very careful with people who have very strong ideologies or beliefs. And these people who are extremely pro-crypto, or they remind me of these nutcases who are usually very, what's it called? People who say all these conspiracy theories, or veganism, or this or that or that. It's like, look, I like the concept of crypto. I agree that it could, I'm not saying it will, it can provide potentially a good hedge, but, and it's a big but,
That's a disclaimer. I'm not against crypto. Remember that. It's like someone who says to me, "Yeah, put all your money in Tesla." Like, that's tech market investing. That's something I'm passionate about. But I wouldn't put all my money into Tesla. It's the same thing when someone says, "Yeah, crypto." There's people that say to me, "I've got all my money in crypto," and it's like, "But why?"
Yeah.
It's like, this is, again, we keep name dropping people like Munger, Chamath, Naval, Nassim Taleb, people who are very logical and rational, because this is literally what we're always seeking. Chamath himself mentioned 2 years ago on CNBC, they kept grilling him, and he's an artist at sort of putting the reporters in their place.
Wow.
He really well put it. He said, "No, I'm not saying put all your money in crypto. If you have $100, put $1 in crypto, put it in BTC." My advice is always, everyone has a different risk appetite. If you're an average investor, 10%, 5 to 10% of your portfolio should be speculation. Speculation is angel investing. My friends who are angel investors tell me, yeah, it pretty much is speculating. Angel investing, crypto, anything like that, sure, go for it, 5 to 10% of your portfolio. The other 90, put it in something that's not speculating or speculation. So that's where I really line up with Munger and Buffett's mental models and when it comes to approach of investing. And I'm not saying value investing, because that's not done.
I was going to call you out on that, because Munger's a massive proponent of not diversifying. Stick to the businesses that do well and invest in them.
Yeah, so look, stick to what you know, stick to what you understand. And, you know, if you don't know what you're doing, if you look at the last 30, 40 years of performance of funds, most hedge funds are BS. Even those that invest in tech. If you see the returns, it's BS. It's guys that are just getting management fees to wine dine in London and Manhattan. And
I'm going to snippet that bit of what you said and put it at the front of this episode.
That's basically what it is. And again, please feel free to Google this. Look, there's a lot in my head on surface I know, but the finer details I don't know. But what I do know is, if you'd invested in, let's say, the S&P 500 index fund many years ago, however long, as far along as you could have, let's say 20, 30 years ago, whenever it was in place, if you compare that to hedge fund returns, I looked up the statistic, it destroys pretty much most hedge funds. So it's like, if you don't know what you're doing, just put your money in an index fund, which, to be funnily enough, is heavily skewed by the top 5 or 6 companies, which are all tech.
It's like 45% of them.
Which is the reason we talk about this space and why we discuss this. But yeah.
I mean, how am I going to go after that? After everything you just said? But
value investing, I'm a big fan of it, but it's not what it was in the last 10 to 15 years. So don't take my advice on it. I would advise against value investing right now. I'm still a huge fan of it. I still study it. I like to see how one can apply it in the modern day of investing, because even look, Buffett and Munger, who have always said we only invest in what we understand, we never touch tech, and Apple we consider more of a consumer brand and not tech. We don't touch tech, we don't touch tech, we don't touch tech. A few weeks ago, surprise, even they finally touched tech with the snowflake, and I think they made a 5x return when it IPO'd. So yeah, look, this is why I invest in tech more than any other thing, but it's just, I don't put it all in crypto or all in angel or all in this. Hedge yourself, diversify yourself. If you don't know what you're doing and you've just come across this episode, you're just a new listener, you don't know what the hell all of this stuff is about, just put your money in an index fund.
I'd agree. Where have you invested then?
So the biggest tech company, which I think I've said on a previous episode, 2016, Amazon.
Yep.
Tesla, funnily enough, despite everyone around me pouring into it, I never did.
Yeah, nor did I.
And I got a bit of FOMO, and a few months ago I got even more FOMO post-COVID. I think, when was it? It was in May when it skyrocketed, or June, July 2020. We're now in early October. And recently, again, look, when I looked into how many cars Tesla makes per year versus, let's say, a more traditional BMW, and you look at and you compare the top line to the actual the market that they're addressing and how much they're putting out into the market and producing, you're like, something's not right. Is it a lot of hype like most tech companies are? Or some people's argument is, actually with Tesla, you're betting on, it's not a car company. This is where some of the tech pros come in, and they say it's a data company. So again, that's where for me, it's a bit of a blur. I still don't understand it enough. So fortunately, I never touched it, despite getting a bit of FOMO. I got FOMO in crypto years ago. I made some, I lost some, I learned my lesson. And again, this is on the pursuit of being a rational investor, or as rational a human being as you can be. These are the things I've learned.
It's interesting you say that. So I don't know if you were following the news maybe it was months ago now, but SoftBank was one of the entities that was market moving essentially. It was wailing, if you will, in the market. So maybe that's a good thing you didn't touch some of the tech stocks in that sense. We'll get onto Tesla, I'm sure, in another episode, because I have a lot of thoughts. I don't think it's a data company.
Your expertise is energy tech, so I know you can talk about that for 5 hours.
So when someone asks me what's Tesla, I always say it's an energy company. But anyway, we can pick up on that in another episode.
Yeah, some say data, some say energy/battery company. Some say no, it's a car manufacturer.
Well, it is. It's literally a car manufacturer.
But yeah, I agree. That will open a whole new can of worms, and we'll touch on that in a few episodes. Look, I suppose we've riffed on a lot of different things. I don't want to drag this on for too long because every episode is just going to be us getting excited and shouting different things. To wrap up, I'm just looking at final bullets here. Is anything to wrap up? No. I mean, there's a lot we can cover. Like, we can go touch on rolling funds, SPACs, more recent developments in the space of fundraising. But we'll save those for future episodes because they're a topic in itself, and an episode dedicated to each one.
I mean, if you think we fanboy over Naval, wait till we do that episode and talk about Angel List. But yeah,
cool. I suppose final question for you, just wrapping up on everything we've discussed. We've bashed it a little bit, but also spoken highly of, you can make high returns, but depends on your risk appetite. Don't invest in what you don't understand, blah, blah, blah. But to wrap up, why would you say, in your view, why valuation's so high? And if you can, okay, that could go on for hours. Yeah. If you can answer 2 questions, 1 minute each. Why valuation so high? And the question which you asked me and I didn't answer because I rambled and I planned to answer. Question 1, why valuation so high? Question 2, where do you see the VC space going? If you can spend 6 to 7, roughly a minute each, and then we'll wrap up. So, and I'll give my thoughts.
Where the VC space is going, let me start with that one because it's easier to answer. I don't think much is going to change. I think we'll pick up on rolling funds and essentially the democratization of funding of startups soon. We'll pick up on that in another episode.
Yep.
And I think what that does is it institutionalizes a little bit and traditionalizes, if that's a word, VCs. So they're going to become more of the private equity type business. And so you'll see this new wave of things coming in, but we can pick up on that on another episode. Why are valuations so high? I think we need another episode for that one as well.
We've discussed a lot of the points already, but
yeah, the fundamental reason for me that valuations are so high is partially down to the democratization of investment. So everyone going on Robinhood or eToro or whatever it is to put money into things. Mm-hmm. Now that doesn't explain a lot of the market moving elements though, because institutional investors are the people that really move markets, right?
Yes.
And I think valuations are really high because people get to some level FOMO of investing in the right tech. But also the really interesting thing about tech is if you don't get in at the right point, you don't see the outsized returns.
Yeah.
And so people get FOMO around what time they need to enter. But also it's a good hedge, as you say, right? So institutional investors will throw money at it. And when demand skyrockets for a specific stock, you're going to see that price rise. And when that does happen, the valuation of these companies goes up. For example, however, companies like Amazon, I don't have a problem with its valuation. I think it's actually rather fair. It's Google where I'm unsure what the hell Google does anymore. Is it advertising revenue? Is it other things that it's doing? Is it the multitude of areas that it's invested in? And we can pick up on that in another episode on valuations and actually pick up on Peter Thiel's 0 to 1 on that, because I think he picks up on he really drills deep into Google, for example, as a company, and then why it doesn't want to be seen as a monopoly, even though it kind of is. But the fundamental nub of it is the be all and end all of it is valuations are high mostly because tech is misunderstood by investors.
Agreed. So I'll give my very quick answer. Agree on that point, misunderstood. There's a bad side of it, which is greed, FOMO,
Oh, Bob, have you heard David invested in this? Oh yeah, I should go in that. Oh, I only put in this much in that. I should have put more in. I'm going to put more in now. Bring down my dollar cost average over time.
Who's Bob and Dave that you know?
Again, just examples. But hey, look, there's one bad side of it, which is greed and FOMO.
Yeah.
But there's a really good side of it as well. It's some of the valuations you think are high, but they are high for a reason, and they should be as some are actually in my view not high enough if you study some of the correct examples. So why are some so high? Because one, it may be because for those who are not too familiar, they might have great contracts with customers, very sticky recurring revenue for long term. They have great visibility of revenues. There's low churn, there's low attrition. They're not losing many customers, and they're adding more customers. And these customers are all tied into long-term contracts. And the previous customers keep renewing these long-term contracts. So it's sort of it's proof of, not proof of work. It's proof of it's proof that it works.
Yeah.
It's proof that it works. Also, the management teams you bet on. If it's an impressive manager, like Elon Musk is probably most people bet on him because of his past. But then you could talk about the PayPal mafia as well. If you're a member of that team, anywhere you go, I'm sure you'll have a great amount of success because of the sort of social proof, but also experience that you bring with yourself. So people bet on not only the visibility of revenue, but management teams. And look, end of the day, and also they bet on the intangibles as well, because a lot of companies will have, some will say, yeah, it's vague notions of brand, but some companies do develop a great, let's say, for example, in my view, Netflix, when Reed Hastings and Patty McCaw 20 years ago, they developed this culture deck, which a lot of people were like, oh, this is so cutthroat. Some people like me think it's fantastic and amazing. It's the best culture to have. You have a place for only A-player high performers, and everyone else kind of gets a severance package. So they're companies that are very clear on culture, they're very clear on goal, vision, mission, principles.
But that explains why companies do well. Does it explain why there's such high valuations of those companies?
To an extent, yes. To an extent, no. The extent that it doesn't is the first part I explained, which I said part of it is agreeing with you, it's misunderstood, there's FOMO, there's greed. The good side of it, some companies are rightfully valued at such valuations that some would think are high, but it's actually because they have impressive contracts, they're growing. If they grow as they have been growing exponentially, they're going to hit cash flow profitability very soon. And look, you laugh at that.
Shouldn't they be hitting cash flow profitability already? Right?
But look, this is why I was such a huge proponent of Amazon, and I invested a few years ago. Because why? Because I love free cash flow generation. I'm not really a huge growth equity investor. When I say that, it doesn't mean I'm against it. It's just I haven't understood it as well as I've understood public market cash flow profitable tech equities. And as I've been learning more and more and working with startups and actually understanding, like, hey, every time we raise funds and we do fundraising and we put more money into this growth initiative and do this and new product launch, new market launch, it's like a lot of it is for a reason, and it goes back to risk appetite. It's like a lot of investors who are well versed know that they're betting. They're not investing, they're betting.
Yeah, exactly.
And they're fine with it because they say it's go back to what I recommended earlier, 5 to 10% of your portfolio for speculation. I'm happy to do that. They're happy to do that. Great. Just depends on your risk appetite. Where most people get it wrong is that there is no self-awareness in today's world. People are not self-aware or sit down and reflect or journal or think, what is my risk appetite? If this happened, then this, then that, then this. They don't have that sort of engineer's way of thinking, or just going back to first principles. If this happens, then it means I'll be out on the street. But some people don't think that way, and some people do genuinely end up on horrific stories I've heard of, like a teenage investor on the Robin Hood app who committed suicide because people are not educated on these things. So, and of course that's a different situation, and that I don't want to go into, but I'm talking about more, investors who are in their 20s, 30s, 40s, 50s. Some of these people never sit down to think, what is my risk appetite? Like, what do I want to do here? What is the end game? There are people around our age who've said to me, I just want to be filthy rich. I just want to be swimming I want to be in my man. I've literally heard this from people. Some
I'm not naming any names, but some who are, they're perceived to be very sort of reputable or established in the tech industry or whatever. Some say, I just want to be in my mansion by my pool on my phone doing deals, or I want to be filthy rich I want a 10 fleet for Ferraris, and I'm like, but why? There are a lot of things that I wanted years ago that I didn't have. Then you get the basic things and you're like, this doesn't actually excite me that much. So as Charlie Munger says, reduce your expectations. Spend less than your income, put away all of that as much as you can into investing and savings and stocks and whatever. Let it compound. If you live long enough, you will be rich. Just be irrational.
How did the question on valuations get hit?
I think I have this disease where I just go on for too long. But I was just.
It's good advice.
I put out some wisdom that I've learned from the maestro. That was my point on valuations. And look, some of it we don't know. Some of it is literally a blur. It's what we're trying to find out with this podcast. So hopefully with people who have been in the industry for 40 years, they'll be able to explain why in their view valuations are so. That's our view anyway. The other one, where the VC landscape is going, VC space, as you said, democratization of investing. Someone took a hit at all the rolling funds and solo VCs the other day, saying all these rent seekers are now starting funds. Everyone's starting funds. Nobody's starting businesses. I disagree.
Yeah. Well, they are businesses.
I think too many businesses, some are great and are not able to get funding, especially now there's a huge focus on, let's say, ethnic minority founders getting funding as well for their startups. So, look, to wrap up, because I've gone on for so long, my point being, it's great. More people should be starting rolling funds and solo VCs and micro VCs and all of these things. I'm a huge fan of it. I don't agree with this comment on Twitter calling them rent seekers, because there are lots of great ideas and sometimes they don't get the funding that they deserve.
Yeah, agreed.
And this is great. This is why we're doing this. Whether you're building tech or investing in tech, great. We're a huge fan. So that's where I see it going. And there's going to be more funding. Funding in the past, in 2020, has been at crazy levels that you'd have never imagined despite a pandemic. In March, if you'd said that this much funding has been sort of circulating, flowing in the US and Europe and UK, would have been like, no, get out of here. But now we're sitting here in October and we've had a phenomenal year in tech with funding. So I think I'm as Matt Ridley, I'm a rational optimist and the future is bright. I'm super excited about the space.
All right. Well,
any thoughts to wrap up?
No, I think you succinctly put that quite well.
Succinctly.
Yeah.
Awesome. Cool. Look, if you let us talk, we could go on for hours and hours, and I suppose we enjoy it so much, and this is why we're doing it. As I keep quoting, but as Naval says, when you enjoy it so much that for you it's like play, it's not work.
Yeah.
For us, we could be here till like tomorrow morning. We're like, oh, we didn't realize it's tomorrow morning. So yeah, we'll try and be more concise. First few episodes, we're still learning. Feedback is very welcome on how to shape future episodes, and there's a lot to cover. So stay tuned, and we'll catch you in the future episodes.
Peace.